Good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Friday, October the 10th. This month is already running away. With us, I'd like to welcome Daniel Rahmat first, Senior Energy Security Consultant in Iran. Daniel, welcome. Great to have you with us. We'd like to get your perspective on sort of regional geopolitics, please. From Iran's perspective, we've had this peace deal announced for Gaza. If that holds, and that's a big if, what does that mean for Iran and for oil markets in general, in your opinion?
Hello, everybody. Hello, Dayala. Uh, yeah, this
Yep,
we
exactly.
everybody hopes that this is an end to the massacre in Gaza, and this was a huge, actually, I can call it milestone in the history of our region. For the first time in the contemporary history, we are witnessing a genocide in front of the eyes of the world, and the world remained comparatively silent, and there was a big loss to the humanity there. And this started 2 years ago, as you know, in October 7th, an attack from Hamas and a massacre of more than 1,000 people in Israel, and that really shook the whole world and the region, and also made a big risk to the energy markets. Iran, as a traditional ally and supporter of Hamas, was very much affected by this. And that war ended up in another war in Lebanon, death of many people, innocent people, together with Hezbollah supporters and guerrillas in Beirut and South Lebanon. And that really changed the geopolitics of the region and the functions controlling the international politics in our region. Iranian oil
Yeah, what
production
does it
and
mean for Iran?
export.
Because a lot of people I've talked to this week, when this deal was about to be announced, the market commentators were saying, well, the Gaza deal doesn't make any difference to the oil price or stability because it's not really going to impact things. But of course, it does impact things in relation to what happens next with Iran and sanctions and the US, more importantly. Behind the scenes, certainly Iran has been taken into account as this grander peace deal is formulated.
You know that the Gaza issues are directly related to Iran, but at the same time very independent from Iran. You know, Iranian oil goes 100% to China at this moment, and China has always been trying to keep itself away from the issues going on in the region, while it's not affecting the energy security of Beijing. So I think I agree with many that this does not very directly make any change in the flows of Iranian crude to China, which is now about 1.7 million barrels per day. And while this could somehow affect the security of Iran, I'm not in a position to comment whether this would encourage Israelis to launch the second round of their attacks on Iran, or that would give them a kind of stability or confidence to calm down and stop aggression in Iran. So I think this would not directly affect the flows of Iran to China, but there are some signals coming from China that the snapback has kind of frightened or scared the
Yeah.
Chinese buyers of Iranian crude, especially in Shandong. That's a long story, but I think Gaza would not directly affect.
Okay, thanks, Daniel. Caroline Bain, CEO of Bain Commodities, welcome back to the program. Caroline, give us your take on, again, sort of geopolitical risk premiums, including the Russia angle as well. Russia-Ukraine, which has no sign of abating that war. How much are commodities markets factoring in geopolitical risk these days? Is it all priced in? Are there new elements for it to consider? And what does that tell you about the trajectory for commodities like oil and gold? Not necessarily that they're related, but going forward in the fourth quarter.
Yeah, I mean, it's hard not to say that the political risk isn't already factored into commodities, given what we've seen with gold in particular.
Yeah.
There's a lot of chatter at the moment about gold and oil moving together. I think it's worthwhile thinking about the factors that have pushed up the gold price and those that have kept the oil price perhaps higher than it would otherwise have been, and that's definitely the sort of geopolitical angle. But the economic uncertainty that has been pushing up the gold price as well, and the idea that we might need an inflation hedge, for example, none of those are actually very positive for oil demand at all. So I think we have to be quite careful about saying all boats move up at the same time.
Yeah.
The factors driving gold are both economic and political uncertainty, I think.
Does the weakening dollar help oil move up a little bit? Is that correlation also sort of being thrown array?
Traditionally, it would do, but it should also well, no, well, I think we've seen a bit of a disconnect, certainly in the traditional relationship between gold and the US dollar this year. It seems to, I suppose, because one of the factors that has been driving the gold price is higher is concern about the role of the US dollar and in the global marketplace, whether US tariffs are going to mean that less dollars are required. Have countries lost faith perhaps in the US as their reserve currency? Whole question of central bank independence. So I
Yeah,
think we're
especially
looking
in
at a
the
period
US.
where we're not going to see that necessarily perfect inverse relationship between gold and the US dollar.
Yeah, that point about central bank independence, particularly in the US, obviously, with the pressure coming down on the Fed from the Trump administration. Andy Lavin, Managing Director of Econs, welcome back. Andy, good to see you again. We have one bulletin headline today, Citigroup warning of oversupply, warning of bearish oil market sentiment because of oversupply. And we've had this oversupply glut versus tight current supply, short-term supply debate in the last few weeks. China, stocking up on inventories and demand not as weak as it could have been. Where would you say we're going to go in the fourth quarter and first quarter of next year, oil price wise and market balances wise?
So I think it's a bit of potato, potato, tomato, tomato. It kind of depends what you want to write. I think where we are today, it's fairly easy to say from the supply perspective, there isn't a problem with supply. However, you can also argue that the excess supply sitting in OPEC Plus has over the last few months been reduced as they've upped their numbers. Depending upon whether you want to go down the path of they weren't really numbers, they've just upped the numbers and the production hasn't gone up, or whether it is that the production has gone up. It kind of doesn't matter. There's less surplus capacity. So you're kind of getting a pressure there. And on the demand side, I think it's fair to say that demand uncertainty has more downside risk than upside risk. There are a lot more things you can see going on in the world today that may lead you to believe that demand is going to be weaker. And therefore, you can play it from different perspectives and you come up with kind of the same answer that it's probably currently weak, but I wouldn't actually say it's strongly weak. I would say that something could happen and suddenly it all kind of changes picture because either the supply is much better or the demand is much better.
So it's a lot of unpredictability to come, obviously, as we head into winter as well, obviously, and seasonal factors that should be typically guide us. Daniel, let's get, as we take advantage of having you today and get also an update from you a little bit on the sort of domestic political front in Iran. Things have seemed to have gone all quiet since July. We've obviously had the attack on Iran. You're saying it's possible, and others say it's possible Israel could do another one. It would seem amazing if they did, given the deal that's just been signed, and essentially US choreographed deal for the region. But what is the domestic mood at the moment, both economically and politically? Are all talk of sort of regime change, transition over, and we're sort of back to square one? Obviously, you've got the nuclear program angle there as well, and what Iran's prepared to do on that front from a negotiation point of view.
Look, in terms of domestic economy, Tehran stock exchange market has already lost 33% of its value in US dollars since July. So
Wow.
that is a huge, I can say, collapse in the stock exchange market. Real has already lost 20-something% of its value since July. And inflation has ramped up very significantly. And this inflation comes together with recession. So you can see that domestic economy is not doing well at all. And regarding politics, I
Will
think
that push Iran quicker to do what the US wanted to do with any sort of revived
I
potential
don't
nuclear
agree.
deal, for
I don't
example?
think so. I don't think so. Because, Iran wants a deal and has tried to reach a deal with US since the inauguration of Donald Trump and tried very much for that. Even before that, since the new president in Iran in September 2024 was elected, let's say. But Iran failed to reach a ground with the United States that could clearly tell Iran what do Americans want. This is a complex issue. Americans want kind of, as Donald Trump says, full surrender, but they don't even say what does full surrender mean, and they don't even say to what extent they're going to ask for more and more. Every time Iran goes to the negotiations table with an answer to the previous demands of Americans, they come with a new demand. Now they have asked for a reduction of the range of Iranian missiles to 500 kilometers, which means Iran would be 100% vulnerable against any kind of Israeli attack. This is not something Iran would accept. Last year, I wrote an article in Petroleum Economics that Iran would remain loyal to its promise to the East, means Russia and China. And now Iran is, in terms of external politics, international politics, getting more radicalized if it fails to reach a deal with Americans. Russians have already started equipping Iran after the inauguration of the 25-year strategic agreement between Iran and Russia, which started last month. So Iran would become another playground for Russians against America if Americans continue to put more constraints on Iran and try to push Iran towards a full surrender.
Yeah.
Look, Iranian economy in terms of GDP is $440 billion, but Iranian GDP PPP is $780 billion. So Iranian economy is a huge one and can supply everything for its domestic use, and people are getting poorer and poorer. Iranian economy is kind of getting Pakistanized. Demand destruction in many actually consuming goods is occurring. But that does not necessarily mean a surrender for Iran. Iran would resist against this, I think, and Iran would go more under the Russian umbrella, and that would mean
Yeah, that's the risk.
a
Well,
lot
not the
of
risk, but
shocking
certainly
news
a new
maybe this
risk.
year.
A new
I
risk.
think there is even a possibility of sending land troops to Ukraine if things go worse for Iranian establishment here.
That's
So
one
there are a
card
lot of
they can possibly
possibilities.
play.
Yeah,
Of course,
and
you've got
as long
China
as
on the other
China is
side,
buying
though.
Iranian oil, Iran
China's
would
buying
resist.
Iranian oil. It probably is having a bit of an influence on Iran in terms of what it might do in foreign policy as well. Caroline, talking about China, let's look at that economy from a commodities demand and supply point of view. It produces commodities, it consumes obviously many. What direction should commodities markets be taking from China's economic outlook going forward as the year ends and into 2026? Oh, you're on mute. There you go.
Sorry about that. The economic outlook is really quite subdued. There are no signs of a sort of sustained recovery in the property sector. That seems to be in a sort of terminal decline, which is very bad news, particularly for the industrial metals, but also for oil demand. It was used quite heavily in construction. So the metals that are particularly exposed, steel, copper, aluminium to some extent, although there are the green economy is helping to offset that in China, because that is still booming. I don't see it. I don't see there's a picture of a collapse in commodities demand, but it's not the sort of growth rates that we've seen over the last 10 years, even 10, 15 years.
Are economists still expecting a 5% GDP growth for China this year?
I don't think so. I mean, we all know there's a lot of question marks about the official statistics out of China. All the signs, if you look at the sort of underlying data, the ones that we can perhaps have a bit more confidence in, suggest that the GDP is not running at 5%. It's probably more like between 3.5 and 4, which is not terrible for commodities demand. And we are certainly seeing quite a lot of additional demand coming through from the EV sector, from technology, but it's going to be difficult to offset the drag provided by the property sector.
Andy, I mean, let's look at oil prices again, and where you're based here in the Gulf, as I am. You know, we've seen them sort of hover around the mid-60s for a while now. And yes, the long-term trajectory may be upwards gradually, but no sort of real sign in sight that we're going to see anything up to 70 or even beyond, unless we have some major event, obviously, in the region. How are Gulf economies, do you think, planning and managing that? I mean, OPEC Plus, which is led by Saudi, has been adding oil to the market. That doesn't help the price go up, does it? So are they happy with this mid-60s? Have they come to terms with it? Where do you see that thinking, if you like?
That's the $64 billion question, I guess.
It's getting trillion. We have to go into $1 trillion questions now with inflation.
That's true, yeah. So happy, I think no. But I think what they are probably happy with is the relative stability that exists. Because essentially, if you kind of take it all back to the countries planning their budgets on an ongoing basis, what they want is stability. They want stable cash flow, because then you can plan. But the level it's at the moment, as you've seen with a lot of the news coming out of Saudi even, is that they're having to cut back on some of their big projects because they don't have the cash flow. But it's like it's a bit of a chicken and egg situation. If you don't have the cash flow, you don't do it. But actually, how do you get the cash flow? Well, we need a higher oil price. But if you push the higher oil price, all sorts of things should happen. So maybe it's better to be pragmatic about how the oil price develops over as the years go by. And in that context, I think OPEC are probably reasonably comfortable where they are. They're putting more oil on the market. They're getting more market share. And the price isn't really reacting negatively against them, taking them down that path. So in that context, are they happy? Yes. I think the challenge is that last set of conversations you had with Daniel and Caroline, there isn't a lot of positive news, certainly about demand. There isn't we've got a whole bunch of demand that's going to happen because the economies are growing and this, that. No, it's all negative, negative, negative. And that's, I think, why we're kind of seeing this very slow rollout and very measured kind of increases.
Very small increases. I mean, Daniel, on that front of OPEC, what's your opinion on their strategy? You know, now going into the fourth quarter, continuing with their pledge to increase incrementally into this market. Of course, Iran sort of has an exemption from OPEC Plus at the moment because of its sanctions conditions. It hasn't really been involved in any of the machinations of the last 2 years. But from what you hear within the group, would you say that this is OPEC trying to sort of tidy up its books, you know, get everyone back to realistic baselines by sort of emptying the coffers, emptying the spare capacity, and then perhaps having a fresh start? Putting Iran aside, your opinion on where the group is going in terms of how it's managed the market?
You know, I very much agree with Andrew that the uncertainty in demand side would very much harm the prices, and which would very much actually harm the prices as well. But on the supply side, we also see more barrels coming to the market. You know, Iran apart, that I would say Iran at this moment is not able to very much increase its output. In September we had even a slight decline in the Iranian output according to OPEC, but according to International Energy Agency, the decline was very, very significant. International Energy Agency says that Iranian oil output in in August decreased by 300,000 barrels, which I don't necessarily agree with. But we can see the Kurdistan oil flows towards the market has restarted again, and there are more barrels coming from Saudi Arabia, and this
And the
would very
Iraqi
much
flows, yeah.
harm the market, actually price stability. But I think Saudi Arabia has a plan, as Andrew said. They just want to revive their market share. And considering the risks for Iranian barrels going towards China, Saudi Arabia and other Gulf states are kind of securing the barrels to China in terms of supporting China's energy security. So in the case that Shandong refineries stop or decrease buying Iranian crude, that would be an option for the Chinese market to replace with Iranian barrels. So at this moment, I'm not very optimistic about the prices, but I think Saudi Arabia, in particular, and the other Gulf states would secure their market share against this instabilities in the market.
Okay, Caroline, I mean, let's talk a bit about Russia again, but not just in terms of its oil. And it has actually had released figures recently that it's been producing at its quota within the OPEC Plus group. But what about other minerals, the rare earth minerals, very much a concern of President Donald Trump, other sort of, mineral resources Russia is very rich in. Has the Ukraine war, how has that impacted that source of revenue, if you like, for the country? And I mean, would you have a particular opinion on that going forward in terms of how it's prioritizing that as a potential revenue stream, given that it's under oil sanctions as well by the G7?
Yeah, I mean, Russia's other resources pale into significance compared to the importance of oil revenue. But they are significant, the actual resources. There was a lot of concern, I think, initially when Russia invaded Ukraine, that mining would find it problematic to deal without Western equipment and Western expertise. That hasn't manifested itself. For the most part, Russia seems to have been able to replace Western equipment with Chinese-based equipment. I do know of problems, particularly in the gold mining sector, actually, with that replacement of Western equipment. But for the most part, it hasn't affected output of metals or minerals. China has struggled.
There was some talk of Russia, I mean, in terms of equipment and the tools that it needs for its oil industry. There has been obviously a lot of commentary on the fact that it has had problems accessing those tools for even oil production.
Yeah, but they don't seem to have been, it doesn't seem to have affected output in a significant way of either metals or oil. So I think gold is actually at risk of talking about gold, but it is in the news. Russia's been encouraging gold production, and the government has been buying a lot of its own gold for obvious reasons, to move away from the US dollar, etc. And that seems to have been really quite a successful policy, but it does mean that Russia hasn't been looking to offload its gold into international markets. And quite a lot of the resources that Russia produces, it's still managing to sell in terms of nickel, aluminium in markets outside the EU and the US.
Okay. We've got our survey question up there. How should oil markets trade Trump's continued weaponization of Justice Department against opponents? I mean, the sort of bullying tactics of Trump on the domestic scene, really, not just with the Justice Department, but with the Fed as well, and others. Is that impacting? Is that having a trickle effect on energy markets? Andy, just back to you. On the tariff front, looking at that from the perspective of the US, of course, those negotiations continue. Trump keeps putting figures out there, using the tariff sort of percentages to negotiate with countries like India and China on other things, such as tech, defense, weapons, etc., buying. That game continues, but has the market become a little more blasé about it, and they're just sort of waiting to see what the final outcome is? How is demand and consumer demand, do you think, and general macroeconomic sentiment now responding, sort of 9 months into this tariff back and forth?
So I think gosh, there's a lot of detail sitting behind it. So I think that the reality is that the tariff headlines are enormous, but the tariff actual implementation generally has been more pragmatic, even though occasionally it comes in and then it goes down and whatever.
I mean,
So
are there indications that those costs of goods are starting to bite both into the US and into Europe, for example, in terms those industrial sectors? Have we seen them filter through to
So I think
manufacturing?
definitely in the US, you can start to see signs of tariff having an impact, and you've seen that first in companies that have tried to toe the line of not passing them on to consumers. And then you get to the point of, but I can't keep going down that path. It has to get to the consumer eventually. Otherwise, you're just going to squeeze the margin of those companies. So you can see that flowing through into the US. I don't think there is a major impact at this point in time in terms of demand, because it's not flowing through into the headline numbers in a big way. And that's a lot of what sits behind the Fed's debate around interest rates. I think the economists all said, "Oh, tariffs will flow through to consumer. It's going to make inflation go up, etc." Well, it kind of did, and it kind of didn't.
It's been a bit,
So
it's
it's
been
not more
steady,
pragmatic.
inflation. Yeah.
Sorry?
I'm saying inflation has been pretty steady for the last few months. I mean,
Yes, but so the challenge there is another cost. So logically, inflation has to go up. Well, it only goes up if it gets passed on to the consumer. If company results get worse because the companies are eating the tariffs, there's no impact on inflation. And that's the dichotomy, I think, that all the countries are kind of facing, because what you don't want to do as a company is pass on the tariffs, and then the tariffs actually go down, and then you have to do a price cut, because you're going to get slaughtered if the tariffs come down and you don't pass on the price cut. So people are probably eating them until they have no other choice, and then it starts. So it's all a lot slower. I think that the market isn't really bringing into play the tariffs per se directly. I think what they're waiting to see is, when is it going to start to have an impact? There is an expectation that there will be an impact on demand. It's a question of when. And then it comes down to, so if it's next year, do I really need to start building it into the prices today? No. If it's in the next 2 months, yes. And that's the kind of decision that everybody's really making. And I would argue that it's one of those pieces of data that is just saying, let's just leave the price where it is, because actually everybody is kind of comfortable with it in this range. But it is one of the downward pressures on demand. Therefore, it is one of the downward pressures on price.
Yeah.
So quite a complicated answer to
It
what
is.
was a relatively simple.
What a complicated question, probably, because it's so many factors factored into it. Thanks, Andy. Daniel, let's close with you very briefly, just to get your take. We have a headline about Turkey gas demand, and shifting to take more US gas, maybe again part of this whole probably international trade negotiations that might be happening behind the scenes, and that might threaten Russian and Iranian gas security of demand. Is that something that Iran even factors in? Turkey switching suppliers, if you like.
Turkey has a contract with Iran to import, I think, 20 billion cubic meters of gas from Iran every year, but Iran is not able to supply that demand. Especially in the winter, which Turkey consumes a lot of gas. Iran has a gas deficit of 300 million cubic meters per day, and is not able to supply Turkey with the Iranian gas. At the same time, Iran is very much relying on its gas imports from Turkmenistan for the northern part of the country, which Iran used to import gas for the cheap price from Turkmenistan, at the same time used to re-export the same gas or something. Now there is another contract between Iran and Turkmenistan and Turkey for swapping Turkmenistan gas to Turkey from Iranian infrastructure, which is replaced with the previous actually swap contract between Iran and SOCAR of Azerbaijan to supply Azerbaijan with Turkmenistan gas. I think Turkey is very much successful in diversifying its supplies from Russia, Iran, Azerbaijan, Turkmenistan, and they're thinking of importing gas from Qatar and also Iraq in the case that they can complete their flaring gas gathering projects. But this has also gave Ankara a kind of leverage for better negotiations, bargaining power against Iran and Russia. But I think they're not going to be able to replace Russian gas because they're very much relying on Russian gas, and Russian gas is the backbone of Turkey's gas hub, regional gas hub, as it's called in Turk's statements. More Azerbaijani gas, I don't think would come very soon, but they have good plans. UAE has invested huge money in the solar power plants in Azerbaijan to increase their export capacity. Also, they're thinking of drilling in the deep Caspian Sea for more gas, but actually gas itself is not a problem. There should be huge infrastructure, both for Azerbaijani gas and also the Turkmenistan gas in the Trans-Caspian project. And nobody is now guaranteeing the investment or return of that investment through the whole pipeline, from Azerbaijan to Turkey to Europe. So that's a huge project and huge investment, which at this moment there are a lot of uncertainties about that. But Turkey is playing very well in this case, and I think in the future, as you know, Azerbaijan is now exporting gas to Syria through Turkey, and that has given President Erdogan a big political leverage as well. So Iran at this moment does not have enough gas to supply Turkey with more gas. Every year, Iran's capacity for exporting is declining. So Iran is thinking somehow for swapping projects with Russia. There is a contract between Iran, Russia, and Azerbaijan to construct a new pipeline to get Iran connected to the gas network of Russia. But this is not going to cover the whole needs of Iran nor Iraq.
Absolutely.
So it's a big story.
Again, as you said, money needed for infrastructure to make all of that happen. Thanks, Daniel. There's our result. No relevance from Trump's continued weaponization of Justice Department against opponents. The oil markets have much more important things probably to pay attention to. Thanks so much to Daniel and Andy, and of course Caroline, for joining us today on this Friday. Have a great weekend, everyone, and look forward to seeing you next week. All the best.
Thank you all. Thank you, Jala.
All the best.
Bye-bye.
Bye-bye. Bye-bye.